Okay, so imagine this. You are sitting at your desk. It is the end of the month. You have just paid your rent, your phone bill, your subscriptions, your groceries, and maybe a little treat because, hey, you deserved it. And you look at your bank account and you think, where did it all go? You worked the whole month, you showed up every single day, and somehow you are right back at zero, maybe even a little below zero. And somewhere in the back of your mind, you have heard people talk about passive income. You have heard people say, let your money work for you. And you are sitting there thinking, that sounds amazing, but I do not have money to work. My money is already gone. If that sounds like you, stay right here, because this video is going to change how you think about building wealth. My name is Guy, and I spend way too much time thinking about dividend investing and how ordinary people can use it to build real, lasting financial freedom. If you are someone who works hard every month but cannot figure out how to actually grow your wealth, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. It genuinely helps more people find this content, and that is the whole point. All right, let us get into it. Here is the thing. Most people who are new to investing think about it the wrong way. They think investing means buying a stock, watching it go up, and then selling it for a profit. Buy low, sell high. That is the version of investing that movies show you. That is the version that gets people excited. And look, there is nothing wrong with that approach in theory. But here is what most people do not realize. That strategy requires you to be right twice. You have to be right about when to buy, and you have to be right about when to sell. And study after study shows that most individual investors are bad at both. A report from Dalbar, which is a financial research firm that has been tracking investor behavior for decades, found that over a 30-year period, the average equity investor earned about 7.13% annually, while the S&P 500 returned about 10.35% over the same period. That gap, that almost 3% difference, is almost entirely explained by one thing: investors making emotional decisions, buying when things feel exciting and selling when things feel scary. Now, here is where dividends come in, and this is where it gets really interesting. Dividend investing flips the whole script. Instead of trying to time the market, instead of obsessing over whether a stock is going up or down today, you are building a system that pays you regularly, regardless of what the market is doing. You are not waiting for the perfect exit moment. The income just arrives. Think of it this way. Imagine you owned a small vending machine business. You place machines in office buildings, and every month those machines generate cash. You do not have to sell the vending machines to make money. The machines just work and the money comes in. That is essentially what a dividend portfolio is. It is a collection of assets that generate cash flow for you on a recurring basis. And once you understand that, everything changes. Okay, so let us make sure we are all on the same page here. What actually is a dividend? When a company earns profit, it has a few choices about what to do with that money. It can reinvest it into growing the business. It can buy back its own shares, or it can distribute some of that profit directly to shareholders in the form of a dividend. Companies that pay dividends are usually large, established, and financially stable. We are talking about companies like Johnson & Johnson, Procter & Gamble, Coca-Cola, Realty Income. These are not startup companies burning through cash trying to find their footing. These are businesses that have been generating profit for decades, and they are sharing a portion of that profit with their investors every single quarter, or in some cases, every single month. Now, here is a number I want you to hold on to. Dividend-paying stocks have historically made up a massive portion of total stock market returns. According to research from Hartford Funds, from 1960 to 2023, reinvested dividends accounted for approximately 85% of the S&P 500 total return. Read that again, 85%. Most people think stock market wealth comes from prices going up, but the data says most of it actually came from dividends being collected and reinvested over time. That is an absolutely wild fact that most beginner investors have no idea about. And I want to stop here for a second because I know what some of you are thinking. You are thinking, okay, Guy, that sounds great. but I do not have thousands of dollars to invest. I cannot buy shares of these big companies. And this is where I need you to listen carefully, because what I am about to tell you is the part that actually unlocks everything. Let us do some actual math together. Real numbers, real scenarios. Say you start investing $200 a month into a dividend portfolio. That is it, $200. For a lot of people, that is cutting out 2 or 3 subscriptions, packing lunch a few times a week, maybe skipping a couple of takeaway orders. It is not nothing, but it is also not an impossible number for most working people. Now, let us say you invest that $200 every month into a diversified portfolio of dividend-paying stocks or a dividend-focused ETF, which I will explain in a moment, that has an average dividend yield of around 4% and an average annual total return, including price appreciation, of about 8%. These are conservative, realistic numbers, not hype, not promises, just historical averages. After 10 years, your total invested amount is $24,000, but your portfolio is not worth $24,000 because of compounding and because you have been reinvesting your dividends. Your portfolio is worth approximately $36,800. That extra $12,800 came from your money working, not from you working. Now let us stretch that to 20 years. Same $200 a month, same 8% average return. After 20 years, your portfolio is worth approximately $117,800. And at a 4% dividend yield, that portfolio is generating roughly $4,700 per year in dividend income. That is almost $400 a month, every single month, without you doing anything extra. Now, you might be thinking, okay, but 20 years is a long time. And yes, it is. But here's the thing, that $400 a month compounds further. And if you keep reinvesting, or if you add more to your contributions over time as your income grows, the numbers get significantly bigger. Some people in this journey end up with portfolios generating $2,000, $3,000, even $5,000 a month in dividend income. And once your dividend income covers your monthly expenses, you have reached something very close to financial freedom. Not theoretical freedom, real freedom. Look, I have to talk about this because the math is the easy part. The hard part is the human part. There is a concept in behavioral finance called hyperbolic discounting. It basically means that human brains are wired to value immediate rewards much more than future rewards. Your brain is not broken if you struggle to delay gratification. It is literally working exactly as evolution designed it. In ancient environments, waiting for a future reward made less sense than grabbing the immediate one because tomorrow was uncertain. But here is the problem. That ancient wiring is devastating for modern wealth building because every time you spend money instead of investing it, your brain is making a rational calculation based on a system that no longer serves you. It is choosing the immediate reward, the takeaway meal, the new outfit, the upgrade over the future reward, which is financial freedom. And the financial industry does not help. Social media is filled with stories about people who bought a stock and made 300% in 6 months. Nobody posts about the person who invested $200 a month for 20 years and quietly built a portfolio worth $120,000, generating passive income. That story is not exciting enough to go viral. But that story is the one that actually changes lives. Here is what most people do not realize. Wealth is built in silence. It is built through consistency. It is built through the boring, unsexy habit of putting money to work every single month and not touching it. And dividend investing is actually one of the best psychological structures for building that habit. Here is why. When you are just watching a stock price go up and down, there is nothing to hold on to emotionally. You start second guessing yourself. You start panicking during market dips. But when you are collecting dividends, something changes. Every quarter, your account gets a little deposit. It is proof that the system is working. It is a tangible reward that reinforces the behavior. And that feedback loop is incredibly powerful. All right, let us get practical. This is the part where we build the actual thing. Step 1. Start with dividend ETFs. If you are a complete beginner, do not start by picking individual stocks. Start with dividend-focused ETFs. ETF stands for Exchange Traded Fund. Think of it as a basket of stocks that you buy all at once with a single share purchase. Some of the most well-respected dividend ETFs include SCHD, which is the Schwab US Dividend Equity ETF. It tracks high-quality US companies with strong dividend histories and has an expense ratio of just 0.06%, which is nearly nothing. There is also VYM, the Vanguard High Dividend Yield ETF, another excellent low-cost option. And for international exposure, there is VYMI, which is Vanguard International High Dividend Yield. These funds give you instant diversification. You are not betting on one company. You are spreading your money across dozens or even hundreds of dividend-paying companies, which dramatically reduces your risk. Step 2. Open the right account. In 2026, most reputable brokers, think Fidelity, Schwab, or similar platforms, depending on your country, offer commission-free trading. Open a tax-advantaged account if possible. In the US, a Roth IRA is exceptional for dividend investing because your dividends grow tax-free and qualified withdrawals in retirement are tax-free. That is a massive long-term advantage. If you are outside the US, look into the equivalent in your country. ISAs in the UK, TFSAs in Canada, and similar structures elsewhere offer meaningful tax advantages that can significantly boost your long-term returns. Step 3. Set up automatic contributions. This is not optional. This is the most important structural decision you will make. Automate your contributions so that every month, on payday or shortly after, a fixed amount moves from your bank account into your investment account. Remove the decision entirely. The enemy of investing is hesitation, and automation eliminates hesitation. Step 4. Turn on dividend reinvestment. Most brokers offer a feature called DRIP, which stands for Dividend Reinvestment Plan. When this is enabled, every dividend you receive is automatically used to purchase more shares. You do not see the cash, it just becomes more ownership. And this is how compounding truly accelerates. Your dividends buy more shares, which produce more dividends, which buy more shares. It is a cycle that feeds itself. Step 5. Add individual dividend stocks as your confidence grows. Once you have a foundation of ETFs and you understand how the system works, you can start researching individual dividend-paying companies. A useful concept here is the dividend aristocrats, which are S&P 500 companies that have increased their dividend every single year for at least 25 consecutive years. Companies like Coca-Cola, Johnson & Johnson, Realty Income, and Pepsi have been raising dividends through recessions, through market crashes, through pandemics. That kind of resilience is exactly what you want in a long-term portfolio. When evaluating individual dividend stocks, pay attention to a few key metrics. The dividend yield, which is the annual dividend divided by the share price, the payout ratio, which tells you what percentage of earnings is being paid out as dividends, and lower is generally safer. And the dividend growth rate, because a dividend that grows every year is far more valuable than one that stays flat. Now, you might be thinking, this all sounds straightforward, and honestly, it is. But there are a few traps I see beginners fall into constantly, and I want to make sure you avoid them. Mistake number 1, chasing high yields. This one is really important. If you see a stock offering a 12 or 15% dividend yield, your first reaction might be excitement, more income, right? But here's the thing. A yield that high is almost always a warning signal. It usually means the stock price has dropped significantly, often because the company is in financial trouble and the market is pricing in a dividend cut. When that dividend gets cut, and it often does, the stock price drops further and the income disappears. This is called a yield trap, and it can seriously damage a beginner portfolio. A sustainable, healthy dividend yield in 2026 is generally somewhere between 2.5 and 5%. Anything above 6 or 7% requires very careful research before touching. Mistake number 2, selling during market downturns. Look, the market will drop. It always does. In 2020, the S&P 500 dropped over 30% in a matter of weeks. In 2022, we saw significant drawdowns across most asset classes. These moments feel terrible. Everything is red, the news is frightening, and the emotional pressure to sell and stop the bleeding is immense. But here is what most people do not realize. During a market downturn, If you are in the accumulation phase, a lower price means your monthly contribution buys more shares. More shares means more dividends. A market crash for a long-term dividend investor is actually a sale. You are buying ownership in great companies at a discount. The investors who sold in March 2020 locked in their losses. The investors who kept buying came out the other side with significantly larger portfolios. Mistake number 3, waiting until you have more money. This one might be the most expensive mistake of all. People say, I will start investing when I have a bigger emergency fund, when I get my raise, when things settle down, and months turn into years. The cost of waiting 1 year at an 8% return on a $200 monthly investment is roughly $2,500 in future value. Every year you wait is thousands of dollars you never get back. The best time to start was 5 years ago. The second best time is today. Here is where I want to leave you. Dividend investing is not a get-rich-quick scheme. It is a get-rich slowly, sustainably, and quietly framework. It is the financial strategy that does not make headlines, does not go viral, and does not make anyone feel like a genius at a dinner party. But it is the one that actually works for ordinary people with ordinary incomes who simply want more freedom in their lives. You do not need a finance degree. You do not need a lot of money to start. You need consistency, patience, and a basic understanding of how the system works. And if you have watched this far, you now have that understanding. So here is your action step for this week, not next month, this week. Open a brokerage account if you do not have one. Set up an automatic contribution, even if it is just $50. Buy 1 share of a dividend ETF. Turn on dividend reinvestment, and then watch. Watch your first dividend hit your account. It might be 12 cents. It might be $2. The amount does not matter. What matters is that your system is live and your money has started working. That is how every great portfolio started. Not with a windfall, not with a lucky trade, with one small intentional step. If this video helped you, please hit that like button. It genuinely helps other people find this content, and subscribe so you do not miss the next one. I have a full series coming on dividend investing in 2026 that goes even deeper into stock selection, portfolio sizing, and tax strategy. I will see you in the next one.